Interested in all your thoughts on the potential hyperinflation on the horizon, and if that's something affecting your investing outlook. Tom's got a big smile. Maybe we'll pitch it to him first.
No thoughts and no effects.
Tom's not a macro guy.
Yeah, I pay attention to a lot of macro stuff, but it doesn't affect the way I invest. So I do think we're going to go through some type of fairly high rate of inflation. We probably already are, but it's not going to change the way I'm investing. I'm going to keep doing what I'm doing. I'm not going to go and buy some crypto or gold or whatever you want to choose. But yeah, I'm paying attention to it, but it's not affecting the way I invest.
Is it fair to say the best antidote to hyperinflation is just owning great businesses, Frank? Does that jive?
Bitcoin, bro.
Where is Bitcoin, bro?
Should I go change?
No.
I think the best antidote to hyperinflation is owning good businesses with pricing power, and/or this might be something that doesn't get talked about probably enough in value investing circles, but potentially also having debt on assets that can go up with inflation, like real estate, for example. Because you're borrowing money and buying assets in today's dollars, but paying it back in tomorrow's dollars, very inflated.
Yeah, I can't see myself making I don't think I'll ever make a hedge to inflation, but if I was, I'd be thinking more so towards a company with great pricing power moving forward, like a Coca-Cola is something that Buffett kind of has, whether it was intentional or not. Ray Dalio has a lot of those type of companies, the Alibabas, Coca-Cola, McDonald's, companies like that. I guess that's a good move to make. And then there's real estate is another option. I don't think I'd move towards gold or crypto or anything like that. It's a little bit too unpredictable. But realistically, I'm just happy to buy great businesses and ride it out.
Cool. Karan, did you have anything to add before we jump to the next one?
I mean, I kind of like something that I read recently in that book, the book you mentioned, Richer, Wiser, Happier, about Matthew McLennan. And he does hold gold in his portfolio, and he's in the chapter called The Resilient Investor. So I kind of thought about the way he kind of structured gold in his portfolio. He's like, it exists as a hedge. That makes sense. But at the same time, I mean, gold, it's worth what the next person is willing to pay for it. Okay. So it makes more sense to hold a company like Berkshire, I think. That's a better hedge than gold, I would say. I mean,
Berkshire is a tough example. I agree with what you mean, but because they hold so much cash, that one's a little bit... But yeah, it is good to hold a business like that, I guess.
Yeah. You want resilience, you want like anti-fragility in the portfolio. So I think Berkshire is as anti-fragile as they come,
Yeah, and if diversification, like I think Ray Dalio's portfolio is designed exactly for this. So if you really want a better idea, I think Dalio is the best person to listen to. And he has a lot of gold ETFs and maybe a few other hedges in there too. But a lot of these companies with pricing power, he has markets from all over the world. It's about as diversified as you can get.
Yeah, it seems like it's tough to see into a lot of what they're doing because all we can see is the 13F filing, really. Would you agree with that, Frank?
Sorry, I was reading a question. I didn't listen to that.
Oh, no problem. With Bridgewater, it seems like it's hard to get a lot of transparency about what they're investing in because only a small fraction of it is disclosed in the 13F.
Yeah, that's true. And there's also a lot of ETFs in there. You'd have to really dig into all those different ETFs and what they're actually holding. It is hard to really get a grasp on, but you can kind of get the idea of what he's doing with the portfolio.
You guys see any?
What do you think about the all-weather portfolio? The one with like 70% bonds or some 40% bonds, some ridiculous number. Any thoughts?
Yeah, I read about it in a Tony Robbins book, I want to say, Money Master the Game. I think it was mentioned in there. I like the concept, but I mean, Ray Dalio laid out sort of some asset allocation percentages for the all-weather portfolio in that book, but even then he made it very clear to Tony Robbins that he was kind of dumbing it down, and there's there's leverage and options and all sorts of derivatives built into that portfolio as well. So I like the idea of something that can perform, fairly well in most environments, but whether or not you could actually replicate it in real life is a whole other question.
I mean, I imagine Ray's talked recently about moving away from bonds. Have you heard him talk about bonds recently? Anybody?
Just keep saying they're trash. Cash is trash, bonds are trash. That's all he keeps saying.
Yeah, bonds are trash. So, I mean, bonds were a big part of the all-weather portfolio, weren't they? Like 55% or something?
Yeah. Some huge number.
You'd have to figure out how to redistribute that.
Yeah, we're in a weird time where people are buying stocks for their income and they're buying bonds for capital gain because interest rates keep going down.
Right.
That's a bit backwards to normal.